Disclaimer. This is for educational purposes only. I am not a SEBI-registered analyst. Please do your own research and consult a professional before making any investment decisions. This is not financial advice, just insights and food for thought. Is the Nifty 50 flirting with historic valuation extremes? The Nifty 50 index is often seen as the heartbeat of Indian equities. But right now, many investors are asking, are valuations stretched, or are we still in a safe zone? Let's break it down step by step in a way that both beginners and seasoned investors can relate to. Step 1. Understanding the historical context. Over the past 10 years, the Nifty 50 has traded at an average price-to-earnings PE ratio of ~20.3x, with a standard deviation of ~4.85. If we use statistics, this gives us valuation zones. Mean 3's ~5.75, ultra cheap zone, mean 2's approximately 10, 6, deep value zone, mean 1's ~15.45, undervalued zone, mean approximately 20, 3, normal fair value zone, mean plus 1's ~25.15, slightly expensive, mean plus 2's approximately 30, very expensive, mean plus 3's ~34.55, extremely expensive. This framework helps us measure where we are today compared to the past. Step 2. Where are we now? Currently, different data providers put the Nifty TTM-PE between ~19.9x and 21.7x. That's around the long-term average and slightly below some recent averages like the 5-year average ~23.9x. So, in plain English, we're not in ultra-cheap territory, we're not in extreme bubble zone either. Instead, we're hovering in the normal to slightly expensive range. Step 3. Why this matters. Valuations don't tell you what will happen tomorrow, but they do influence long-term risk and return probabilities. Historical research shows, when PE 13, the chance of negative returns across time horizons is almost zero. When PE 27, risks of volatility and long break, even periods increase dramatically. So, while we're not in danger zone right now, history suggests staying watchful above 25-27x. Step 4. Investor psychology and inflection points. Here's where it gets interesting. At 2025x, investors often feel okay. Markets look fair, optimism is balanced, but once valuations cross 30x, fear of a bubble usually creeps in, and even small shocks can cause outsized reactions. At the other extreme, when valuations fall below 13x, panic is usually high in the market, but history shows those are often the best entry points for long-term wealth creation. Step 5. Practical questions for you. Now let's turn the mic to you. Ask yourself, do you adjust your equity versus debt allocation depending on Nifty's valuation band? Would you consider lightening equity exposure once we cross 2730x? Does the current 2022x zone feel comfortable to stay invested? Or do you think even this demands caution given global uncertainties? The bottom line. Right now, the Nifty 50 is not in a bubble. It's sitting close to its historical comfort zone, but that doesn't mean complacency. The smart investor doesn't just ask where are valuations today? They also ask, how much risk am I taking at these levels? Do I have enough diversification to survive drawdowns? Am I ready to increase equity exposure if valuations go cheap again? Because ultimately, valuations don't predict short-term moves, but they do shape long-term outcomes. Key takeaway. Nifty is normal to slightly expensive, not extreme. Watch 2730 XPE as the red flag zone. Below 15 XPE has historically been a golden opportunity zone. Stay balanced, stay disciplined, and use valuations as a compass, not a crystal ball. Final thoughts. Markets will always oscillate between greed and fear. The job of an investor is not to time it perfectly but to recognize where we stand in the cycle and position accordingly. So over to you. Do you trust valuation bands for your investment decisions, or do you prefer to stay invested regardless of market levels? Drop your thoughts.